are here, and there's Kyle. Hey, how are things going? How is the homework? Okay. Last period, what we did was we covered a kind of a hodgepodge of little subjects to kind of start tying up chapter 10, didn't we? So your homework was in regards to those. Let's go over those now. I think the first one I assigned was Quick Study 10.5. Is that correct? Okay. All right, let's take a look at Quick Study 10.5. Okay, on January 2 of 2017, the Matthews Band acquires sound equipment for concert performances at a cost of $65,800. The band estimates it will use this equipment for 4 years. It estimates that after 4 years, it can sell the equipment for $2,000. So they're saying that's the residual or the salvage value. Matthews Band uses straight-line depreciation, but realizes at the start of the second year that due to concert bookings beyond expectations, this equipment will last only a total of 3 years. Salvage value remains unchanged. What's the revised depreciation for both the second and the third year? Okay, well, let's take a look at this. All right, okay, first of all, let's remember what the formula is for when we revise depreciation, okay? The formula when we revise depreciation is the book value at date of change minus revised salvage value, right, divided by the number of remaining periods. Okay? Book value, we know, if you don't know by now, it's cost less accumulated depreciation, correct? So, in this situation, let's figure out what depreciation we did for the first year, okay? The depreciation, or the cost was $65,800, is that correct? Minus a salvage value of $2,000. And then what were we originally, what was the original estimated life? 4 years. So what does that equal? What's that equal?
15,950.
Okay.
Yeah, 15,950.
65,800 minus 2,000 divided by 4.
15,950 per year.
Okay. Thank you. 15,950 per year. Now, we're going to revise depreciation at the beginning of the second year, correct? Right? So, what we do here then is our book value at the date of change, as the slide says, at the point of revision, is $49,850, correct? Which is the cost less the accumulated depreciation of $15,950. All right? Then we deduct salvage value and we divide it by the remaining years of life, 2, and we get 23,925. Okay? If you want to put it into, let's take a look at it in more of this format here. Okay? Then the book value at the date of change is 49,850. The salvage value is still 2,000, correct? And how many years are left? 2. And that's how we get the 23,925 a year for each of the next 2 years. Okay? We don't go back. We don't make any changes to previous years or anything like that. This is how much we depreciate for each of the next 2 years. Maria.
Would it be 47,850 instead of 49, or am I?
Well, that's a good question. You mean right here? Mm-hmm. No, it's the book value at the date of the change. The book value is cost less accumulated depreciation. It's not cost less accumulated depreciation less salvage value. Is that what you did? Incorrectly? Okay. Yes, good question. But no, that 49,850 is the book value at the date of revision. We don't subtract salvage value. Because look, Maria, we subtract salvage value right here. Okay. All right. Cool. All right. Any questions on Quick Study 10.5? If I make a mistake, please tell me. Okay. Okay. Let's go through the next problem that I assigned, which I believe was exercise 10.3. Is that correct? Okay. Let me go ahead and put that there if you need it at home. Okay. Rodriguez Company pays $375,280 for real estate plus $20,100 in closing costs. Okay. Those $20,100 in closing costs are just those ancillary charges and fees that you have to pay your realtor. They're normal and expected costs of acquiring real estate. So we'll capitalize those amounts. The real estate consists of land appraised at $157,040, land improvements appraised at $58,890, and a building appraised at $176,670. Allocate the total cost amongst the three purchased assets and prepare the journal entry to record the purchase. Okay? Now, we talked about some of the challenges in doing this, right? We need to make sure that we book a journal entry that balances, right? We also need to make sure that the total of the assets capitalized equals what we paid, okay? So that we will abide by the cost principle, okay? So let's go through this. All right. Okay, first of all, the total cost of acquisition is $395,380, correct? $395,380. That's the purchase price plus the closing costs, okay? So now what we're going to do is we're going to utilize those appraised values that they gave us, okay? And the appraised values that they gave us are listed as shown for land improvements, and buildings, right? Now those add up to $392,600. So now what we're going to do is we're going to figure out the percentage of total. So all we're doing is a little allocation here. 157,040 divided by 392,600 equals 40%. 58890 divided by 392,600 equals 15%. 176,670 divided by 392,600 equals 45%. And of course, those need to add up to 100%, right? They gave us pretty clean numbers, so we didn't have to round or anything. Then what do we take that percentage times, folks? We take it times the 395,380. Okay? The 395,380. And then the apportioned costs that we arrive at are shown. This gives us our journal entry. And of course, you need to make sure your debits equal your credits, right? And sometimes there might be a situation where you had to round a little bit, and that's fine. I don't care if you're off by $1 or $2 or something on these amounts. But the journal entry needs to balance exactly. You with me? Okay. Did you guys get that? All right. Any questions on exercise 10.3?
I have one.
Yeah.
So you took the percentages by the 395,380.
Yeah.
So then where do you book the, I mean, because I see the closing costs up there. Then where do you put that down below? You know what I mean? Like.
Okay, it's a great question. What you're saying is this closing cost of $2,100 isn't really segregated anywhere. Okay, this is a lot like, it's exactly like when I said, okay, let's say JCCC buys some equipment that costs $5,000. It's $200 for the delivery of it, and then $100 to unpack it and put it together. Remember how we capitalized it at $5,300? And that $200 and that $100? It's capitalized into the cost of these assets. And it will be depreciated, except if your land improvements and buildings will be. Does that make sense? Great question. Very good question. Other questions? Okay, I believe the next one was exercise 10.11. Is that correct? So let's take a look at exercise 10.11. All right. This is a partial year situation, isn't it? Okay. Exercise 10.11. On April 1 of 2016, Cyclones Backhoe purchases a trencher for $280,000. The machine is expected to last 5 years, have a salvage value of $40,000. Compute depreciation expense for both 2016 and 2017, assuming the company uses the straight line method. Okay, we can do that. Again, we talked about what we have to do when we do partial year depreciation. It's pretty intuitive, I think. Okay. I guess what I do first on these is I calculate what depreciation would be for a full year. And depreciation for a full year would be the cost of 280 minus the salvage value of 40 divided by 5 years, correct? 48,000. And we had this asset in operations for a full year in 2017, correct? Okay. Well, what about 2016? Well, how many months did we have it in operation? 9. So what we're going to do for 2016 is we're going to take that 48,000 times 9/12. And for 2016, we depreciate 36 grand. You with me? Now you can round to the nearest month. Let's say that we had purchased this on April 8th instead. Okay, you don't need to go to, 365 days as your denominator. You can just round to, okay, what's round to the months as far as how many months you had it. Does this make sense? Okay. So if you had it in operations for 8.8 months, just round it to 9 months. Okay. So there is the answer. Does that make sense? Okay. Questions on that, folks? All right. Let's do the next one, which is 1013. Is that right? Okay. This is another revision of depreciation one. Okay. Apex Fitness uses straight line depreciation for a machine costing $23,860 with an estimated 4-year life and a $2,400 salvage value. At the beginning of the 3rd year, Apex determines that the machine has 3 more years of remaining useful life, after which it will have an estimated $2,000 salvage value. Compute the machine's book value at the end of its 2nd year and the amount of depreciation for each of the final 3 years given the revised estimates. Okay? All right, we can do that, right? All right, once again, let's take a look at the formula. The formula, if I can get all my papers here straight. The formula for revising depreciation is the book value at the date of change minus the revised salvage value divided by the number of remaining periods. Is that correct? Okay, so let's take a look at this problem. Okay, let's figure out what we were depreciating for the first 2 years, right? The equipment cost $23,860. And what was the salvage value? 29,000 or 2,400? Is that correct? And what was the original estimated life? Okay. So, if we do that, what does that equal? Let me bang that out on my calculator. 23,860 minus 2,400 divided by 4 equals, I did it wrong. What'd you guys get? 5,365?
Yep.
5,365 per year, correct? So, if we go to the formula that we need, book value at date of change minus revised salvage value over the number of remaining periods, we need the book value at date of change, don't we? Okay, so let's figure out the book value at date of change. Okay, the cost of the asset is $23,860, right? The accumulated depreciation, how many years have we depreciated at 5,365? 2. So 2 times 5,365 is 10730. So the book value at date of change is that 13,130? that correct? Is that right? Okay. So, following this formula, we're going to take 13,130, the book value at the date of change, minus the revised salvage value, which I believe is still $2,000, isn't it? Or, let's see. What's the revised salvage value?
Oh yeah, 2,000. It changes to that.
Okay, yeah. Let me look one more time, make sure I don't make a mistake. It was originally 2,400, which is what we used up here, but now it's been changed to what?
2,000.
2,000. So 13,130 minus the revised salvage value of 2,000. Okay, and then they determine the machine has 3 more years of remaining useful life. So this is divided by 3 years. Is that correct? All right. So that, I think, comes out to 3710 per year. Is that correct? We don't go back. We don't make revisions or changes in previous years on a change in estimate. This is just the amount that we depreciate for the next 3 years. Cool? All right. That was 1013. One more, is that correct? 1014. Okay. 1014. Let's take a look at that. Oki Company paid $264,000 for equipment expected to last 4 years and have $29,000 salvage value. Prepare the journal entries to record the following costs related to the equipment. Okay, during the second year of the equipment's life, $22,000 cash is paid for a new component expected to increase the equipment's productivity by 10% per year. Okay, what is that? Is it a capital expenditure or is it a revenue expenditure? It's a capital expenditure, right? Because it's going to increase the productivity, correct? So we're going to capitalize it. And when we say we're going to capitalize something, that means we are debiting an asset rather than an expense. Cool? All right. The second one. During the third year, $62.50 cash is paid for normal repairs necessary to keep the equipment in good working order. This is a revenue expenditure. So the account that we're going to debit is an expense. Okay? We're going to just expense it. Okay. Number 3, during the fourth year, $14,870 is paid for repairs expected to increase the useful life of the equipment from 4 to 5 years. That is a capital expenditure. So once again, we're going to capitalize that asset. We're going to be debiting an asset. And of course, on number 1 and number 3, we're going to depreciate that equipment over time, right? Whereas number 2 on the revenue expenditure, it went straight to expense. Questions? All right. Is that it for the homework? Okay. How long did that take you? Okay, not too bad, right? Okay. All right, we're going to talk about a couple other things today. So let's switch over to the PowerPoints. And I want to talk about natural resources. Natural resources. Now, this is under the category of long-term assets that we use in our operations as opposed to reselling or whatever. But natural resources, these are more Mother Nature items that we might buy, okay? And these are assets where we extract something from it, okay? So let me give you some examples. You can come off there. If we purchase a silver mine or a gold mine, we're extracting gold or silver from that mine, right? If we purchase a field that we are going to drill for oil, we are extracting oil from that, right? If we purchase, 10,000 acres of woodland, we are going to extract lumber from it. Are you with me? Now, contrast that with land. When we buy land and we don't depreciate land, remember? That's just land like we put a building on it or, something like that. We're not extracting anything from it, okay? Natural resources are more Mother Nature items where you're taking something from it, okay? Now, what you're going to find is we don't depreciate these, but we do what's called depletion of them. It is all the same, except we don't call it depreciation, we call it depletion. So we don't debit depreciation expense, we debit depletion expense. We don't credit accumulated depreciation, we credit accumulated depletion. But those accounts are the same. It's accumulated depletion is a contra asset. Everything's the same. It's still our way of spreading out that expense over a reasonable period of time, except for natural resources, we call it depletion. Sometimes we call these wasting assets because you're taking something from them. Does this make sense? Let's look at an example. Now, usually what we're going to use when we deplete these assets is a units of production methodology because it makes so much sense, okay? And what we're going to do is it's going to follow the same rules as when we use units of production. We're going to take the cost minus the salvage value over the total units of capacity that we think we'll have with that natural resource. This gives us a depletion per unit, and then we'll take that depletion per unit times the number of units extracted and sold in a period, okay? Let's look at an example. Okay, Apex Mining, that's us. We acquired a tract of land that contains ore deposits. Now, total costs of acquisition and development were $1 million. And we estimate the land contains 40,000 tons of ore. Okay, we think that's the total amount of tonnage of ore. Now, salvage value is assumed to be 0. Now, during the first year of operations, we extracted and sold 13,000 tons of ore. So let's figure out how much we're going to deplete for that first year. Well, we take that cost of that cost of $1 million less the salvage value of 0, divided by the 40,000 tons, the total amount of tonnage that we think is in that ore field or ore deposit. That gives us a depletion amount of $25 per ton. In the first year, we extracted and sold 13,000 tons, right? So we take that 13,000 times the $25 per ton, and we get 325,000. There's our journal entry. We don't debit depreciation expense, we debit depletion expense. We don't credit accumulated depreciation, we credit accumulated depletion. Does that make sense? Okay. Any questions on that? Okay, you can come off that. I think we'll have some homework questions in regards to that. Okay. All right, let me switch gears a little bit. Okay. What we're going to talk about now is how do you account for things? How do you account for fixed assets when you have to dispose of them? Okay. How do you account for assets when you have to dispose of them? Okay. Now you could dispose of those. You can come off that. You can dispose of assets by selling them and maybe getting some cash. You can dispose of assets by, sometimes you actually have to pay cash out to dispose of an asset. Can you think of an example where you don't actually receive cash in disposing of a fixed asset, but you have to actually pay cash? Well, think about if JCCC had a building on the edge of their campus and they wanted to get rid of that building. They would have to pay somebody to tear that thing down and haul all the stuff away, right? Okay. Or on a smaller scale, there's a lot of assets that you can't just go toss in the dumpster, right? And you actually have to pay a disposal fee, right? Like we're getting ready to get a new big screen TV. You're not supposed to throw big screen TVs in the dumpsters, are you? Okay. So I think you can take them to Best Buy and pay like a $10 fee, and they'll properly dispose of it. But that would be another example, right? Okay. So there are times you have to pay cash out, but there's times that you sell an asset and you receive cash. There's also times where there's no cash that goes out or comes in. Maybe you literally just throw it in the dumpster, okay? You just throw it in the dumpster. But these are different ways that we dispose of assets, right? Well, how do we account for those? That's what we're going to talk about today. But what we need to do before we talk about disposing of assets is we need to introduce two new accounts. Okay, this is the first time that I have brought up these accounts. So this is important. If you still have your flashcards, I would add these to your flashcards. Okay, you can go to the screen now. Okay, we are going to introduce two new accounts, and those two new accounts are called loss on blank and gain on blank, and that usually means like loss on disposal of assets, or loss on sale of equipment, or gain on sale of assets, or gain on disposal of equipment. These are gains or losses that are derived from something else. Are you with me? Okay. Now, let's talk about these, and I'm going to show you an example. Okay. Let's talk about a loss account first, like a loss on disposal of equipment. A loss is very similar to an expense account because it is a normal debit balance. It goes on the income statement, and it is deducted in arriving at net income. It's also a temporary account, and it's closed in the closing process. Now, I'm going to show you an income statement that has a loss on it, and you'll see how this is true. Remember, I said it's very similar to an expense account. It goes on the income statement, and it's deducted in arriving at net income. Well, let's zoom in on this income statement right here. Okay? This has a loss on sale of equipment. And do you see how that is deducted in arriving at the net income? You see that? So it's kind of like an expense because an expense is deducted, isn't it? You following me? Okay. Now, let's talk about a gain on account. A gain on account, it's very similar to a revenue account. Very similar to a revenue account. It is a normal credit balance account, and it also goes on the income statement, but it is added in arriving at net income. And it too is a temporary account, and so we close it in the closing process. Okay? Now, let me show you an income statement that is an example of when there is a gain. Okay? See how that gain is added in arriving at net income? Okay? Now, somebody might say, well, Dave, why do you do these gains and loss accounts? Why don't you just have like a miscellaneous revenue account? If the gain is like a revenue, why don't you just put it in miscellaneous revenue? Well, that's a good question that you just asked. Okay? Here's the reason. Take a look at this. This gain on sale of equipment. Now, this is equipment. We don't know what type of company this is, but maybe it's a landscaping company, and they decided to sell one of their trucks. And they have a gain on that. Okay? And we'll see how that can be computed. But do you see how that gain on that sale of that truck for that landscaping business, that's not really a transaction that's in the normal course of business, is it? Are you with me? Landscaping companies do not exist to sell their trucks, right? So we don't want to put it into a revenue account because revenues are more like things that are in our normal operations. Are you with me? Expenses are more things that are in our normal operations. Gains or losses are kind of unique situations. Said another way, think of it this way. You wouldn't want a landscaping business. Let's say you have a landscaping business who they're not doing very good in landscaping, which is what they're supposed to be doing. They're losing money. So what they do is they sell a lot of their fixed assets and have gains. Well, you wouldn't want them to be able to bump up their revenue by selling off their fixed assets and purporting that that's part of their operations. Are you following me at all? That's why we use the gain and the loss equipment. It's kind of the way to tell the reader, okay, these things are added or deducted in arriving at net income. They do go on the income statement, but we want to make a special account for it because it's kind of a unique deal. It's not really part of the normal operations. You with me? Okay. So that is a gain loss. Going back to the slide, is there any questions on that? Oops, let me go back to Is there any questions on these accounts? Okay, you can come off that for a second. Okay, let's talk about how we dispose of plant assets. Now, there are 5 steps in disposing of plant assets, okay? The first step is we're going to update depreciation up to the disposal date, okay? And there you might be using that same methodology whereas you had to do a partial year, right? But let's say you disposed of an asset on April 1st. Well, you would need to, per this first step, book depreciation for those first 3 months of that year. Does that make sense? So you'd have to figure out that partial year, and you'd have to book that depreciation, okay? Now, let's talk about the next 5 steps, or the next 4 steps of the 5. These 5 steps, or these 4 steps of the 5, are where we build our journal entry to dispose of this asset, okay? These 4 steps are all building our journal entry, okay? The second step is we have to remove the asset from the books, okay? So if it's a piece of equipment or a machine, we're going to have to credit machine or equipment for whatever the cost was. We have to take that plant assets off of the books because we don't have it anymore. We disposed of it. Then we need to remove the related accumulated depreciation from the books, right? If you don't have that asset, well, you don't have that related contra asset anymore either, right? Now, accumulated depreciation is a credit balance, so we're probably going to have to debit accumulated depreciation, correct? Then we're going to record any asset given or received. For example, cash. If you had to pay out cash or if you received cash, you have to record that by either debiting or crediting cash, okay? And if there's no cash given or received, well, then you don't have to do this. And then the last thing you do, this is important. If needed to balance the journal entry, you record a gain or a loss, okay? The debits need to equal the credits. If you do steps 2, 3, and 4, and the journal entry doesn't balance, then you balance the journal entry. If you have to debit something to balance it, then you debit a loss on disposal. If you have to credit something to make the journal entry balance, then you're going to credit gain on disposal. You with me? Let's work through an example, okay? All right. On September 30 of 2017, Evans Company sells a machine that had originally cost $100,000 for $60,000 cash. The machine was placed in service on January 1 of 14. It was depreciated using the straight line method, and it had an estimated salvage value of $20,000 and a useful life of 10 years. Okay, see what the situation is? All right, so let's switch over to the document camera and let's figure this thing out, okay? Now, I want you to remember those 5 steps, okay? Remember those 5 steps. And what was the first step that we have to do? Update depreciation up till the date of disposal, okay? So I'm going to go ahead and put this up here so we can kind of see that original data, okay? So we bought this equipment on January 1 of 14, right? And it cost $100,000. What was the salvage value? $20,000, right? And what was the estimated life?
10 years.
10 years. So we have been depreciating $8,000 per year. Is that correct? You with me? So, in 2014, we depreciated $8,000. In 2015, we depreciated $8,000. In 2016, we depreciated $8,000. Now we're at September 30 of 2017. Correct? So, we have to do the first step. We have to figure out the partial year depreciation and book that entry. Correct? Well, how many months have we had it in service? 9. So we're going to take 8,000 times 9/12, and what does that equal?
6,000.
6,000. So we're going to book that entry at 9/30 of 17. That's our first step. You with me? So now in 2017, when this is over, when this is done, we have depreciation of $6,000 for 2017. Are you with me so far? Okay, so what is accumulated depreciation? How much is accumulated depreciation? 8 plus 8 plus 8 plus 6 is 30,000. You agree? Okay. So the first step is we updated depreciation to the disposal date. Now we're going to build the journal entry. Okay? Let's build the journal entry down here. Okay? This will be our debit column. This will be our credit column. Okay? All right. The second step was remove the plant asset from the books. Is that correct? Is that right? So we are going to credit machine. This is the old one. Thank you. There we go. Thank you. We're going to credit machine for the cost. What was the cost of the machine originally? 100,000. Okay, the next step is we remove the related accumulated depreciation from the books, right? How much is the accumulated depreciation on this machine?
30,000.
30,000. So accumulated depreciation is a credit balance account. Thus, to take it off the books, we have to debit it. You with me so far? Okay, the next step is we recording the asset given and received. Did we receive or pay out any cash? What was the situation?
Received.
We received how much cash? We sold it for 60,000 cash. Well, if cash is coming in or increasing, then we debit cash for 60,000. Now, what is the final step in the process? If needed, record a gain or loss to balance the journal entry. Does this journal entry balance? It does not balance. Which side needs help?
Debit
Debit.
side.
Debit side. How much help does it need?
It's a gain of 10.
10,000. So what account do we debit? Since it's a debit, what do we debit?
Wait, completely.
Gain on.
Look at the step. If needed, record a gain or loss to balance the journal entry. We need to debit something, so what do we debit?
Yeah. Loss
Dollar
on.
button.
Loss on disposal. Are you with me? Does that make sense? We're just building the journal entry down here, aren't we? We're just building the journal entry. Now, if you go to the slides, they kind of go through the same thing, okay? But I kind of like to work it out on paper. You can see that they arrive at the same journal entry eventually, right? Okay? Now, they have this way of figuring out gains or losses by comparing the book value to the cash received. If cash is greater than the book value, you record a gain. If cash is less than the book value, you record a loss. If cash equals the book value, there's no gain. I personally don't say you don't need to learn in that purple box. Just book the journal entry. Just do the journal entry, and if you have to debit the journal entry to balance it, you debit a loss, like an expense. If you have to credit something, you credit a gain. But I think that's easier than memorizing those little rules in the purple box. Just do the journal entry. You gotta do it anyway, right? Okay? So what I want you to do now, we're gonna take a few minutes. I want you to work on Quick Study 10.9. Okay, I've talked enough, that's for sure. Now, I'm going to read this before they turn on that music, okay, because I want to make sure we're all straight on it, okay? Quick Study 10.9 Right there at the bottom of the page. Okay, Garcia owns equipment that costs $76,800 with accumulated depreciation of $40,800. For this problem, you need to assume that that first step of updating depreciation up to the date of disposal, that's already been done. And after that is done, after step one is done, the accumulated depreciation is $40,800. Are you with me? So now Garcia sells the equipment for cash. Record the sale of the equipment under the following 3 separate cases. So you're going to make 3 separate journal entries, each one independent of the other. The first one is you're going to make the journal entry assuming they sold it for $47,000 cash. The second independent situation was, well, what if they instead sold it for $36,000 cash? And the third completely independent situation is, what if they instead sold it for $31,000 cash? So step number 1 is done. So what you're going to be doing is working through these step number 2, 3, 4, and 5 for each of those situations, because step number 1 is done. Does this make sense? So let's work on quick study 10-9 while they play that music. See you in a few minutes. If you folks at home aren't done, just pause this and start us up when you are. But let's look at the first situation. Okay. First situation is we sell it for cash of $47,000. Is that correct? Okay. So once again, we have done the first step, but we're doing steps 2, 3, 4, and 5, right? Okay. So we take the equipment off the books that we're disposing of. We take the related accumulated depreciation off the books. We record the cash that we received. And this is sort of this is kind of an accounting plug, isn't it? Would you agree? This is what we have to do to balance the account. The journal entry, I should say. Is that what you guys got? Okay. Okay, second situation was we received cash of $36,000. So we take the equipment off the books. That's our second step. Take the accumulated depreciation off the books. Record the cash given. Now the final step is, does this journal entry balance? Does that journal entry balance? Yes, it does. So we don't have to do anything, do we? Third situation, when we receive cash at 31, we go through the process. We take the equipment off the books at 76.8. We take the related accumulated depreciation off the books. We record the cash that we received in this case of $31,000. That right there, that journal entry doesn't balance, does it? So which side needs help? The debit side. Since it needs help on the debit side, we debit loss on disposal or loss on sale of equipment. Either one's fine. Are you with me? Yeah, well, I would probably, I wouldn't take off on a test if you said loss on sale, but I think it gives the reader more information if you say loss on sale of equipment, because it could be loss on sale of a building, loss on sale of a vehicle, it could be loss on sale of an investment. We'll learn about that in accounting too. So I like to give them a little bit more information. But I wouldn't just put loss either. It's loss from something. Are you with me? Okay. All right, guys, thanks a lot. As always, do the homework on your homework sheet. We're getting to the end, folks, okay? I think we actually start chapter 11 next time. Bye-bye.